Hi, I'm Kevin Hassett, Director of Economic Policy Studies here at the American Enterprise Institute. I've been here for going on, I guess, 17 years. And when I first came here after being a senior economist at the Federal Reserve, I was placed in an office next to Allan Meltzer, who was at that moment, I think, maybe halfway through the first volume of the landmark history of the Federal Reserve. And so not only having worked at the Federal Reserve, but having had lunch many, many times talking about Allan's history, I've followed closely over time the massive transformation that has occurred at the Fed, not even just in the last, since the financial crisis, but over my lifetime and before. And to think that the first 10 years of my life we were on the gold standard, it suggests that things have changed a lot. And so when a friend at the Wall Street Journal called up to ask if I would review a new book by a young University of Pennsylvania professor named Peter Conti-Brown called The Power and Independence of the Federal Reserve, I jumped at the chance because of two things. One, that I really do love the Fed. I think that it had a big positive impact on my professional life, and it's a very important place here in Washington filled with people who want to do the right thing. They sometimes fail, but I love the spirit of the Fed. But the second thing is that I had noticed that not many people have been writing books about the Fed ever since Allan wrote his really 3-volume. This is a part 1 and a part 2, but it's a 3-volume thing. There are 3 types of economists: those who can count and those who can't. So he's got 2 parts to a 3-volume history of the Federal Reserve, but not many people have written. And one of the reasons is that Allan's history is such an extraordinary accomplishment. In the journal, I likened his work to Gibbon, and it's true. But the second thing is that if you go outside of the sort of realm that Allan existed in Federal Reserve history, then there's a heck of a lot of sort of weird conspiracy stuff going on. And Peter writes about that in his book a little bit. But if you're going to start to think critically about the Fed and even say, hey, this isn't what they were designed to do, then you're going to have a lot of people walking down that path with you that you kind of wish weren't there with you. And so I think that almost because really thinking about is what the Fed's doing constitutional. Is it the case that the founders in 1913, when they wrote the Federal Reserve Act, thought that this is what they might be doing? That as soon as you start talking about stuff like that, then you can start to look like a crackpot. And so Peter's defense of that is to write this really incredible, scholarly, thoughtful book about what's happened to the Fed since 1913, not from the perspective, like Allan, of an economist, but from the perspective of an attorney and a legal historian who thinks a lot about whether the thing that you're doing you have the legal authority to do, and so on. And so Peter was kind enough to agree to come and to tell us what he's learned as he's spent the last, I would guess it's 5 or 6 years, it looks like to me, working on his own Federal Reserve history. And then after he does that for about 25 minutes, we're blessed to hear from 2 of my former colleagues who are the 2 that I couldn't, if I were to have a dream team to discuss this, I guess if I could get Alan Greenspan to join the panel, then this is what the dream team would look like. Alex Pollock, who spent many years at the American Enterprise Institute and has moved across town to our street. And, of course, Allan Meltzer. And so Allan will be the first discussant, and Alex will be the second. They'll each go for 10, 15 minutes, and then we'll open up for general conversation around 6:30. I will be the moderator throughout, and we'll finish promptly at 7, at which point we're going to have a reception out there in the main reception area where Peter will be selling and signing books. So with that, Peter Conti-Brown.
Wonderful. It's such a pleasure to be with you today. Thank you, Kevin, for organizing this event. When I was last here to talk about the Fed a little over 2 years ago, I joked that I was impressed you'd invite a Democrat into your midst here at the American Enterprise Institute. That was a particularly lame joke, even by the low standards of someone who's introducing a talk about central banking. jokes can be pretty lame and still get a laugh. But that one's kind of especially lame because the truth, of course, is that AEI is a serious place where people talk about serious things, whatever one's ideological priors. And besides, in light of the huge, or is it pronounced huge? Results of the Republican primary, I may not be the only one voting Democratic in this election cycle. Now, please note, I had many other hilarious Trump jokes prepared to introduce my talk, but my dear friend and mentor and AEI regular, Judge Steve Williams, is here, advised me that good taste would counsel toward more sobriety. So that's what you get. I will have a lot more to say substantively about what a Trump presidency would look like for the Fed and the Fed independence. Now, today's also a special honor because I'm sharing the day, as you see, with my friend Alex Pollock, and of course our host, Kevin Hassett, but also with Allan Meltzer. Now, for a young historian of central banking like me, there's no greater honor than to have my work engaged by Professor Meltzer, who, as Kevin noted, he rightly called in his review of my book, called Meltzer the Gibbon of Fed historians. So my thanks to you, Kevin, again, and Alex and Allan for being here. Now, hopefully my buttering up the panel will dull the critiques that are coming in the discussion after my talk. This is probably a false hope. If anyone knows Allan Meltzer, he is not one to pull punches, and we do have a few important and good faith disagreements about Fed independence. So Kevin asked us, into the title of today's presentation, has the Fed gone too far? I'm going to be making a somewhat different point and raise some related preliminary questions. What is the Fed today, and what is the best mechanism or mechanisms for ensuring that the Fed is the central bank we want it to be? So in reframing this argument, I'm following a tradition that started with this man, Walter Bagehot. Now, if you get nothing else from today's presentation, will be how to pronounce this important man's name. It's a shibboleth of sorts in central banking circles. He's Walter Bagehot, not Bagahot, as it's spelled. And pronouncing it incorrectly, at least among central banking types, is like going to a sports bar in San Francisco and commenting loudly on what an impressive three-point shooter Stephen Curry is. So it's Walter Bagehot. You're welcome. And thank you for the one person who watches NBA basketball and Steph Curry. All right, please Google Steph Curry highlights. You'll really thank me for it. So Bagehot is famous because of a book that he wrote in the late 1860s, early 1870s called Lombard Street, sometimes unjustly and mistakenly credited with introducing a novel theory of central banking and its emergency lending functions. But the book, in fact, is much more of a tract in favor of central bank transparency and governance, topics that I'll have more to say about in today's talk. But in his introduction to this important volume, he starts in talking about the subject of the Bank of England, that it inspired a lot of existential certainty among interlocutors. I don't know if you can see that well, but in his words, two hosts of eager disputants on this subject ask of every new writer the one question: are you with us or against us? And they care for little else. Now, I can give you my assurance that nothing has changed between 1873 and 2016. From chatty cab drivers to academic colleagues, foreign central bankers I meet at conferences, to journalists, the most frequent question far and away when people learn that I've written a book about the Fed, and I'm obnoxious enough to let everybody know that I've written a book about the Fed, is the same. Or are you for it or are you against it? And my hope with today's talk and with this book itself is to push past that. And I recognize this is going to be a Sisyphean task, perhaps. One need only look at the titles of books that pour forth from the printing presses to get a sense of this phenomenon. Not all books are given the titles as staid as a history of the Federal Reserve. And I'm really glad to hear Kevin Hassett call out our dear Professor Meltzer in writing 3 volumes and calling it 2. It is really a 3-volume history of the Fed. Most of these books, in fact, have much more scintillating titles: The Creature from Jekyll Island, The Secrets of the Federal Reserve and Poorly Drawn Eagles, The Stuff of Conspiracies and Slightly Better Drawn Eagles, The Temple Insiders Who Run the Country. This is actually a good book. Its conspiratorial title notwithstanding. And then my favorite title, Do They Think They Walk on Water? Fed Chairman and the Federal Reserve. And while much of this conspiracy mongering trucks in anti-Semitic stereotypes and spin yarns of equal parts ignorance and bad writing, there is a sense that the Fed pulls the levers of total power over the economy and the country, even with very serious books. And again, William Greider's Secrets of the Temple is a very serious work of history and journalism. And so we get other books that are much better regarded. Central bankers are lords of finance. They're the alchemists, turning mortgage-backed lead into fiat-backed gold. See David Wessel here? Central bankers are God, I guess. And in any case, the only game in town. It's little wonder, then, to bring a picture that might hurt you a little to see and pine for a past that didn't become a future. Senator Rand Paul, it's a little wonder, then, that he would find, at least initially, a somewhat receptive audience with a question that kicked off his campaign. Anybody feel like the Fed's out to get us? So there's this feeling. There's something powerful, there's something mysterious, there's something sinister about the institutions that control our money. And these questions are as old as the Republic itself. It was the battle between Thomas Jefferson and Alexander Hamilton, the battle between Andrew Jackson and the lesser-known Nicholas Biddle, and the battle between the great commoner William Jennings Bryan and the hard money Republican William McKinley. This last one is less well remembered. Perhaps the Hamilton musical's success will lead to a new Wizard of Oz remake that will focus on the story behind the story with William Jennings Bryan. But regardless, this kind of idea, this contest, this feeling that institutions control our economy, our institutions, political and economic, is a very old one. Now, it's tempting to think that in asking the question, well, why does this conspiratorial idea exist then? It's not just the idea that money is controlled by these institutions that prompts the conspiracies. Maybe it's because what the Fed does is just outside of the usual conversations that most people have day to day. I mean, the kinds of things that the Fed does, the words don't really roll off the tongue over the dinner table, even for things that are as important to people's lives as negative interest rates or capital adequacy of banks, quantitative easing, forward guidance. What are these things? Well, it's just too technical, perhaps. But the technical aspects of the Fed's work don't distinguish it by any stretch. As a law clerk, to invoke Judge Williams' good name again, as a law clerk on the DC Circuit, we called interacting with the technical jargon of administrative agencies administrative law. It happens everywhere. I still remember my first two cases in chambers. I'm not sure if Judge Williams does. They were both on the Clean Air Act, and good grief, I still haven't recovered. This multiplies across substantive realms, whether we're talking about securities law, communications policy, other motherlode of them all, at least in Judge Williams' chambers, federal energy policy. The law of bureaucracy is a technical one, so there's nothing special about the Fed in this respect. So to give you another cover of another book, this handsome volume that some of you, I hope more of you after the talk is over, will have in front of you. I think the reason why so much of what the Fed does and is inspires smart people to ask questions and when they don't have the answers to lean on conspiracy theories comes in this title of the book, both from its extraordinary power and its exceptional independence. As powerful and perhaps as quote-unquote independent as the EPA or the FCC or FERC is, and as powerful as those entities are over their slices of the economy, there's a reason why the Fed chair is sometimes called the second most powerful person in the United States after the president, or as some have said, the second most powerful person in the world after Pope Francis. But it's not power alone, it's independence. And today I want to peel back some of the mystery behind that term, independence. And I also want to push back with Walter Bagehot against some of the certainty of those interlocutors, those eager disputants who demand to know where each of us stands on that question, are you for the Fed or against it? That perhaps we can put our guns back in our holsters a bit, sit back and ask harder questions about what is the Fed and what, after all, do we mean by this term, independence? It's ubiquitous in the discussions of the Fed, and so today I want to talk more about what that is. And we have a standard account. We use it to describe independence and justify it at the central bank. And it goes something like this. Fed independence is a legal separation between politicians, usually we're talking about the president facing a national electorate, and central bankers, usually we mean the Fed chair. And the reason for the separation is so that the Fed chair can use purely technocratic tools and skills of macroeconomics to keep inflation low. Now, the president also has an interest, sometimes perhaps in keeping inflation low, at least generically, but the president also has a bigger interest in re-election, or if termed out, maintaining a good legacy. And so when he or she has to choose between re-election, legacy on the one hand, and inflation on the other, inflation is going to go out the window. So a central bank is created. It's given independence to prevent that result, to prevent the president and other politicians from goosing the economy artificially. Now, the metaphors of Fed independence come tumbling forth from there. It's a Ulysses contract, reminding us of Odysseus for reasons that aren't entirely clear to me. In central banking context, we usually refer to the Homeric traveler by his Latin name. And this Ulysses contract comes because Ulysses desired to hear the sirens without destroying himself, his men, and his ship. Now, our politicians then in this metaphor are lashed to the mast using lashes of law. We hire central banker oarsmen and women with beeswax, also made of law and macroeconomics. And we stuff that legal and macroeconomic beeswax in their ears so they can guide our ship to a land of prosperity with low inflation. We, the people, by the way, are the sirens in this metaphor. Fast forward a few millennia, and we get a different but also pervasive metaphor, this one from the long-term Fed chair, William McChesney Martin. And he says, the Fed is in the position of the chaperone who has ordered the punch bowl removed just when the party was really warming up. Now, interestingly, although not inappropriately, given the past near decade of Fed policy, it's much easier when you Google punch bowl to find people spiking the punch as opposed to taking the punch bowl away. But again, that's the general idea. The Fed chair is keeping us interested in the party, but not getting it too out of control. In my book, I argue that this Ulysses chaperone model of Fed independence and its 5 assumptions. Number 1, that law is doing the work. 2, that the president is the only relevant outside audience trying to influence the Fed. 3, that the Fed is a single entity. 4, that the work of central banking is purely technocratic and devoid of values, judgment, or ideology. And last, that the Fed exists primarily or even exclusively for price stability. This model is wrong. Now here I think is where Professor Meltzer is probably, his ears are perking up and the debate will be joined. Sometimes this model, though, is wrong because it's incomplete. Sometimes it's wrong just because it's wrong. So if the Ulysses chaperone model is wrong, what's right? And that's what my book is about. First, the Fed is a they, not an it, to misappropriate political scientist Kenneth Scheppel's apt description of Congress. The Fed chair matters, no question about it, but the internal governance of the Fed reveals that there's so much else going on within it to set the parameters within which the Fed operates, with participation from governors, who are themselves political appointees, other members of the Federal Open Market Committee, Reserve Bank presidents, not selected by the president, and including Fed staff, especially economists and lawyers, but also bank examiners. So these are the other parts. Now the second, the president matters, no question about it. But so too does Congress and bankers, financial markets, international central bankers, academic economists, and many others besides. Focusing exclusively just on the president as the outside influencer or attempted influencer of Fed policy misses the much broader reality of how Fed makes policy. Third, law matters. By law, we mean usually the Federal Reserve Act, but here's the important point. Law matters much less than we think. And I'll give a couple of examples in a moment, but the bottom line is that the idea that law creates independence is mostly false. And indeed, sometimes law does the very opposite of what we've been saying it does as far as insulating the Fed from political machinations. So instead, what else then? Law, custom, history, leadership, and ideology matter an enormous amount about the ways that the Fed interacts with these outside audiences. Now, fourth, the idea that the Fed independence can only be justified in terms of price stability. This is a curious assertion. And it's curious because of the intellectual history of both central bank independence and price stability. It arises in a moment in the late 1970s that extends to just before the financial crisis in the mid-2000s. And in that period, the idea of price stability arose as central banks globally participated in a successful experiment at combating inflation, while simultaneously the intellectual apparatus developed by macroeconomists and economic theorists and political scientists were developing exactly what central bank independence would be. This Ulysses Chaperone model is largely the fruit of those labors. Ironically, at about the same time, at least in the United States, the Federal Reserve Act was amended to give the Fed what we often call a dual mandate, which is actually a triple mandate of price stability, maximum inflation, and low longer-term interest rates. So when we add that to the mix of its financial regulatory functions, its bank supervisory functions, its supervision of the payment system, systemic risk regulation, and its emergency lending authority, we see that the Fed is a multi-function entity. Now finally, and perhaps most provocatively to my central banking friends, the idea that central banking is purely the work of technocrats is also false. Now this is not to say that technical training is irrelevant, very far from it. The point is that the most interesting, and indeed the hardest questions a central banker will face are also those where the technical apparatus is exhausted. After technical and technocratic consensus has broken down, there's a gap between that breakdown and the point at which decisions are required. Now, this raises the question, what fills the gap? Now, you can say central bankers who are making decisions with which you disagree are making them because they're corrupt or they're stupid. But I think the softer reality and the better reality is that they're making these decisions not because they don't understand the question as well as you do, but because that gap is being filled by a different worldview, different values, to use a word central bankers hate, a different ideology. Now, that word ideology, the reason I say central bankers hate it is when I gave this to a very senior central banker in manuscript, he read the book, gave good comments, and he said the part I hated was this idea that central bankers are doing anything at all ideological. There's no ideology anywhere in what we do. And I wanted to emphasize, when I say that central bankers are ideological, I'm saying that they're human, all right? I'm not saying that they're partisan, that they're trying to make the central bank do something to make Donald Trump or Hillary Clinton win an election. Instead, what they're doing is refracting a world of uncertainty and under uncertain conditions through their own lenses of experiences, ideas, and influences to bridge the gap between what their PhDs or other training will tell them must be done and that in scenarios that have been historically defined and what they confront in a world of changing and uncertain conditions. So that's my book in a nutshell, more interesting than this talk because I fill it with lots of historical examples and stories and that kind of thing. Now I mentioned that law is not doing the work that people think it's doing, so let me be a little bit more specific on 2 points. First, a little fill in, sorry, the rest of that chart. So first, let's talk about what how the Board of Governors is structured to insulate them from presidential politics in the Federal Reserve Act and how this actually works in practice. And then second, I want to raise a question recently raised by presumptive Republican presidential nominee Donald J. Trump. Now, whether the president can summarily fire the Fed chair. Now, first, let's talk about the governors. The Fed's main body consists of 7 governors who serve one non-renewable term for 14 years each, which puts them well outside the norm for tenure of administrative officials, makes them start to look more like federal judges. There's something special about the number 14, but that doesn't have anything to do with length of service per se and has more to do with presidential elections. The idea was to have no more than 2 vacancies on the Board of Governors before the national electorate could reconvene to determine whether the president's vision of Fed appointments should be added to the Democratic stew and voted upon, before the Fed had been transformed by a single president. Indeed, to keep that gap at 2-year intervals, the Federal Reserve Act was written so that in the event of early resignation or death, a new governor could fill the stub term So that was the exception to non-renewability. The unexpired term of a predecessor could be itself a part of a term. So that's the legal theory. And what we would expect to see in this last column here is the number 0.5. That would mean that a president gets half an appointment per year, 2 at the end of 4. So take a look again, and you'll see that only one president, John F. Kennedy, had an appointment experience that matched the Federal Reserve Act's architecture. For reasons that we can discuss in the Q&A perhaps, governors simply don't fill their term. There are even incentives in the Federal Reserve Act where you can have cushier jobs through a revolving door if you do fill your term, but they don't fill it anyway. And with all of those early resignations, what it's meant is that presidents get largely to choose their board. So law is not doing the work that people think it's doing the opposite, at least in this case, and there are many others that the book discusses. So that takes us to Mr. Trump. With my apologies to those serious Republicans of the room, from the idea that this entertainer is your standard bearer is still a painful thought. We are going to talk about him because standard bearer he is, and he's raised some important questions about the Fed only recently. He was quoted as saying that he would most likely remove Janet Yellen as Fed chair and replace her, although he said that he favors her policies. So I'm going to put that contradiction to the side and ask this question. Could President Trump legally fire summarily a Fed chair? Here's the way the Wall Street Journal reports it. By law, the president appoints the Fed leader who is subject to Senate confirmation. Once in office, however, Fed chiefs can only be removed for cause. That is, that they commit some sort of wrongdoing or if they are found to be unfit for office. Presidents cannot simply remove a chairwoman or chairman because of differences over policy or party affiliation. Besides the first sentence, there's nothing that's true about what the Wall Street Journal has reported on this question. There is, in fact, nothing at all in the Federal Reserve Act that speaks to the president's authority, or not, to remove the Fed chair. This for-cause protection, referenced in the article, refers to the Board of Governors, not to the Fed chair. And every Fed chair is filling 2 statutory roles. One as a 14-year term-protected Fed governor, and the other as a 4-year term-protected chair. So what about the removability of the governor? Well, that's kind of clear. It says for cause, but for cause is not defined. Other agencies do have the same statutory language where cause is defined as negligence, malfeasance, that kind of thing. But not the Federal Reserve Act. So what does for cause mean here? Well, we would rely on courts to fill the blank. And I think that this supposition is probably correct, although there are some of Judge Williams' colleagues on the D.C. Circuit who have written in concurring opinions that they think the entire for-cause protection scheme is itself unconstitutional and throw that out. But suppose that that is there to stay. Does that mean President Trump could fire Janet Yellen? I think the answer is yes, legally. There's nothing in the Federal Reserve Act that says anything to the contrary. So there's not a legal protection here where we would think the legal protection would be most necessary. But keep in mind what would happen if Donald Trump played that out. Call Janet Yellen, your services are no longer required, you're a Democrat, I'm a Republican, you're fired. That would only fire her from being the chair. She would return and stay on the Board of Governors. And there's an antecedent in history of exactly this scenario. Harry Truman really hated Mariner Eccles. He wanted him out. He said, you know what, I'm not going to fire you, but I'm going to offer you the vice chairmanship because I just want to be a jerk, right? He was the Fed chair and says, you know what, here's the vice chair. Mariner Eccles said no, but rather than doing what Truman expected he would do and return to his millionaire banking empire in Salt Lake City, Utah, he just returned to the governorship and wreaked havoc on the Fed on President Truman from the Fed for another 3 years. So that would mean that Janet Yellen could stick around. It also means that even if there's no litigation that Janet Yellen would pursue in being fired, Donald Trump would then rely on the Senate to confirm the replacement. And there I think the Senate would have a very appropriate position to say, we don't like that tradition. But a tradition it would be, not a legal protection. And I think that's important. So that's an open question then. Would President Trump take that risk? I don't think any president making careful political decisions would, which is why we haven't seen very much of the kind of thing we saw with Truman and Mariner Eccles. But I'll confess that very little Very few of my prognostications about the Republican primary have come about, so I will not go on record of saying anything in particular about what Donald Trump will or will not do, only to highlight just how much tradition is behind what we conceive of as Fed independence as opposed to law. So then let me conclude with saying, addressing Kevin's question head on, has the Fed gone too far? Now, much of my discussion today hasn't been about history, but about structure and governance. But the first third of my book is about history, and I'm writing a new and larger comprehensive history of the Fed to be published by Harvard University Press in about 4 years. And I've pondered this very question, how the Fed today relates to the Fed as it was founded and as it has changed over its century in great detail. And if we were to change the question, has the Fed gone far, the answer would be a resounding yes. Let me give you one quick example that I highlight in the book. There's this tragicomic scene in Fed's early history, where the members of what was then called the Federal Reserve Board, rather than the Board of Governors, struggled with an awkward question of social protocol. The newspapers had dubbed the new board the Supreme Court of Finance, which incidentally will be the name of my new book on the history of the Fed. And the board thought they were, and I'm quoting, entitled to a pretty high place in the social scale. How high wasn't exactly clear, but William McAdoo, the Secretary of the Treasury, the first ex officio chair of the Fed, and the one who begrudgingly had to field these questions, understood sardonically that these bankers and bureaucrats did not want to be, and I quote, pale and distant stars lost in a milky way of obscure officialdom. They must swim in the luminous ether close to the sun. Now, the keepers of the official protocol at the State Department gave an apparently unsatisfying answer, at least to the new Fed board members. And the State Department said the board members would sit in line with the other independent commissions in chronological order of their legislative creation. So that meant that the Fed would follow the Smithsonian Institute, the Pan American Union, the Interstate Commerce Commission, and the Civil Service Commission anytime there was an official state dinner. Now, when this didn't satisfy the status-conscious members of the Fed, the question was taken to President Wilson himself. And as Secretary McAdoo reported it, the shadow of a frown passed over Wilson's face as the nature of the question of the Fed's social standing dawned on him. Well, I can do nothing about it, the president remarked. I'm not a social arbiter. When McAdoo pressed him, the president retorted, well, they might come right after the fire department. Now, McAdoo, evidently pleased as he recounted this exchange in his memoirs, explained that he never told the members of the board that what the president had said, it would have caused them needless pain. Now, the State Department's view carried the day. Now, I relate this story because can you even imagine it today? The idea that a president would say, come after the fire department for all I care. Well, absolutely not. The Fed, as we saw in those book covers, the only game in town. In Fed we trust, the alchemists. Their power is extraordinary indeed. So the question, has the Fed come far? The answer is a resounding yes. But is it too far? And here, as I write the Fed's history, I'm struck by how little of the framers' vision has held sway. But not just today, but in each generational intervention that remakes the Fed in its own image. The theory of institutional change that guides my storytelling in this new book isn't a framer-focused vision at all, but one I think that is more realistic. And that is that the Fed is constantly being reinvented. Sometimes that reinvention comes through formal legislation, like the Federal Reserve Act, of course, the Dodd-Frank Act more recently. But much more often, these kinds of changes happen through the everyday decisions of insiders and outsiders who seek to influence its policies. And this is why elections matter. This is why appointments matter. And this is why governance matters. If we want to know more about the values that fill the gaps after the technical apparatus is exhausted, given how much power resides in those hands, we need to know more about the people whose hands they are. And this is another place where Professor Meltzer and I part ways. This is on the inherent slipperiness and stickiness of law, where law can rear its head generations later in places where we would least expect it. And the place that I'm talking about is why I'd be opposed to writing a monetary policy rule into the Federal Reserve Act. My view is that if we want a Taylor rule, a rule that guides Fed policy making explicitly tied to things like interest rates, output gap, target inflation rates, and the like, then we should put John Taylor on the Board of Governors rather than amending the Federal Reserve Act. Now, the system as we know it today is governed by exactly this kind of archaic structure that barely made sense in 1913 makes almost no sense in 2016. It's better, in my view, not to bury the bodies of temporary political disputes in the Federal Reserve Act, where they can cause future generations so many headaches. This is why in my book, when I think about proposals to the Fed and what ways we might change it, I'm thinking at the level of governance and personnel as opposed to the level of micromanagement. This is also why, and this is here I'll conclude, why this presidential election is, from my perspective of a Federal Reserve scholar and among those who think seriously about monetary policy and financial policy, why this presidential election is so much more important and influential than those in the past. A Romney Fed and an Obama Fed in 2012, after 2012, would have looked different, even including on these very questions of monetary policy rules, no question about it. But the differences would have been between interlocutors who speak the same language and have most of the same values and much of the same technical apparatus they're using to evaluate even competing proposals. The same simply cannot be said about the present contest. In this sense, I'm not sure of the appropriate historical antecedent. In this way, in this area, as in so many other areas, the Trump campaign is taking us into monetary terra incognita. My thanks again for having me. I look forward to this discussion.
Thanks very much, Peter. So before I hand it off to Allan, I have one follow-up question on your presentation. It's just something that kind of puzzles me. And it's that, and it's also a story that I think it would be great to share with the audience. That the same structure that gives us, I guess, if we think, say, Alan Greenspan is a person who I think of as having been very effectively independent in the way I think of independence, although I know it's a difficult concept. But Arthur Burns was the opposite, and they existed in the same legal structure, and that is one of the sort of fascinating parts about the book is when you talk about, well, we've tried to guarantee independence, but look, we got Arthur Burns, we got Alan Greenspan. So the first thing is could you talk a little bit about Arthur Burns and how he wasn't independent and how the legal structure didn't do anything about it? And then the thing that sort of puzzles me is that then if I were a person trained in the law, maybe what I would do at that moment is think about, well, geez, maybe we need to modernize the Federal Reserve Act. We need to come up with ways to make sure that we don't get an Arthur Burns or something like that. Whereas you just despair of that, it seems to me. And so maybe you've learned that laws in this space have no effect, so you might as well give up trying to write them all together. But which is, it almost seems like that's what you're saying. And so could you address, so tell us a little bit about Arthur Burns, and then why is it that we shouldn't try to think more about what we mean by independence and then try to change the Federal Reserve Act?
You bet. So Arthur Burns is a really fascinating figure in Fed history. I think probably many in the room might remember his reign as Fed chair. One of the most interesting stories I relate in the book that I found, and this was not hidden, is Richard Nixon, after the 1960 election, he wrote this book called Six Crises. Has anyone read that book? It was a very big book in the 1960s. Really, it was kind of your modern...
There were about 5 hands.
5 hands.
If there were 6, we'd have one for each crisis.
In the Six Crises, he talks about the 1960 election, and Arthur Burns, who had been the chairman of the economic advisors to Eisenhower, called Nixon and said, you need to get the Eisenhower administration to push the Fed toward easier policies because otherwise the election is going to go to the Democrats. Now, there are 2 things remarkable about this story. Number one, that it happened, this idea, no, we need the administration to really aggressively push the Martin Fed, something that the Eisenhower administration had until then been steadfast about not doing. And number 2, that Nixon and apparently Burns felt so comfortable about this that they wrote it down in a national bestseller. There was nothing to hide about this kind of collusion. Well, it really set the stage for the Burns-Nixon relationship. Some of this is innuendo. So we've got John Ehrlichman writing a book that which is a lot of it is self-serving, but Arthur Burns comes off as just the messenger boy for the Nixon administration, holding off hard decisions in order to keep the Nixon administration politically afloat. But his diary itself has been published recently by the University of Kansas Press. It's called The Secret Diaries of Arthur Burns. And in it, you get all kinds of statements and journal entries where he's saying how much he loves Richard Nixon, how much the Fed's policies, what's good for the Fed and the country is exactly identical as what's good for the Nixon administration's politics. You get almost exactly that statement. And so, yes, we have a Burns appointment that is completely subservient to Richard Nixon. One of the most important monetary decisions that happens in the 20th century, the closing of the gold window in 1971, then finally in 1973. We would think the idea that something like that would happen without Fed input today is unthinkable, but it's exactly what happened. That was a political decision, not a monetary decision. It was one that Arthur Burns hated at the time, but he didn't have any influence there. So yes, we see the Fed then as sort of an adjutant to the White House and Treasury as part of a unified political and executive team, something that some people view as kind of constitutionally required. So when people launch an existential challenge against the Fed, that's often what they're talking about. But why do I think that you can't legislate that away? And part of that is the frustrating tension between democratic legitimacy on the one hand and this idea of technocratic competence on the other. That we want to keep this technically pure central banker doing things with the beeswax in the ears so that they're not influenced by political or partisan electoral considerations. And I think that that is a mirage. I don't think it can happen. I think in this sense I'm downright Churchillian. It's a bad system to have elections influence central bankers at the level of personnel, but identify a better one. Is it to have the chairs of all the economics departments of the Ivy League weigh in and decide who gets to be the Fed chair? I don't think that's a good system. And so what we want to do is we want to have that democratic input where you're going to get people like Arthur Burns, and frankly, Mariner Eccles is one of my heroes. The same legislation that takes the Secretary of the Treasury off the Federal Reserve Board in 1935 coincides with the most subservient Federal Reserve System in history between 1935 and roughly 1951. So legislation can really matter. The Fed's budgetary independence, for example, it's not subject to appropriations. That matters a lot. That's a legal difference, to be sure. But the idea that we can micromanage that structure by writing ever more technical and verbose statutes that really try to solve the last problem, that just leads to an insanity-generating game of legal whack-a-mole. And I think that it's better for us to think about the fact that, to be clear, there are changes I would make to the Federal Reserve structure and its system. But I think the better approach is to think, okay, here's the system we've got, it's flawed. And so we should think very seriously both about the politicians that we elect who will be influencing the selection of these central bankers, but then also vetting the central bankers to such that the attention they receive is commensurate with the power that they wield. We shouldn't see the Republic threaten to carome off the edge of the universe when Antonin Scalia dies, but then just be so dismissive about how many vacancies we've had on the Federal Reserve Board during the entire Obama administration. So I think getting that adjustment better would go a longer way.
Thanks. Allan Meltzer.
How do you turn down an invitation from a friend who is an old friend who refers to you as the Gibbon of history, Federal Reserve history? Can't do that. In any case, I'm happy to return to AEI, where I wrote much of my history of the Fed. The reason there are 3 volumes, just to settle that minor problem, is because the second volume was so big that the University of Chicago Press decided to publish it in 2 parts. Another reason for being pleased to return to AEI to discuss Federal Reserve policy is that I owe a tremendous debt to Chris DeMuth, who was the president of the AEI when the 14 years that I commuted here from Pittsburgh. He supported, I don't think there's another institution of its kind that would have supported me for 14 years and hired extraordinarily good research assistants to do the legwork of going through the enormous amount of material that there is in the Fed records. So I owe a great debt to my friend Chris DeMuth and to AEI for making that book possible. I'm very pleased to discuss Peter's book on Fed power and independence. Let me start with some parts of the book that I like most. The Fed is a political as well as an economic institution. You can't be in Washington without being a political institution. The book appropriately is a work in political economy that gives much attention, especially to the role of the president. The answer to the question that Peter just gave, which said it's impossible to find ways in which the chairman of the Fed is as independent as the law might like to make him, I think he's wrong about that. I think Ronald Reagan, Jerry Ford, several presidents took the position that interfering with the business of the Fed was just not part of their responsibility. So Ronald Reagan never interfered with Paul Volcker. He agreed with a lot of what Volcker was doing, and when the two of them would meet on rare occasions, Paul has told me that what President Reagan would do was tell him jokes. So I believe it's possible. It's not possible with some presidents. It wasn't possible in the current administration, and I'll come back to that. Surprisingly, though, Peter gives less attention to Congress. It's surprising because the Constitution gives Congress the final responsibility for monetary policy and money. It's Article 1, Section 8 of the Constitution that makes Congress responsible for what goes on. And the Fed is the agent of Congress. Congress approved the Federal Reserve and approved this very peculiar structure that Peter would like to modify a great deal more than I would. Professor Conti-Brown has a very interesting chapter on the Fed's senior staff. He's troubled by a few staff that have had political roles. Ted Truman is one of them as the international and head of the international division. Truman was sent to Mexico and Asia on what were essentially political missions. He proposes, therefore, that the senior staff be subject to appointment by the president. What Ted Truman did was political, and it should have been done by the Treasury Undersecretary. It would never have happened to be done by the Fed if Paul Volcker was, as he later became, the Undersecretary of the Treasury. So we need to know more about why a Fed staffer was used. I oppose Peter's idea of having a president appoint staff members because it further harms what little remains of the Fed's independence. Also, there's a good discussion of the rewriting of the rules governing the Fed's operations. These changes over time changed the very central issue that Congress discussed was not how should monetary policy be conducted. That was the gold standard. No one disagreed with the gold standard. At least no one openly disagreed with the gold standard at the time. What they argued about was who was going to control the printing of money. The bankers thought it should be them, and the politicians thought they were the people most responsible, and they argued about that. That held up the legislation for a long time. Woodrow Wilson came up with a compromise, which was that there would be a board called political from the very beginning in Washington, and there would be regional banks to satisfy the bankers, and the regional banks would be quasi-independent. They'd have their own discount rates and so on. Well, that was a misunderstanding of the economics of what would happen once there was a single monetary authority for the country. The bankers lost the ability to have independent discount rates. But the Wilson Compromise was what initially got the Fed Act through Congress. It immediately set off a fight, an argument, over how the Fed was going to be run. And because the strong intellectual ability of Benjamin Strong, it was the banks that got control of the initial Fed operations, and they managed to do that from 1914 until 1933, 35. Anyway, it is good that Peter goes through how these political changes came about and why they came about. From the earliest, D.C. was seen as the political arm of the Fed, with the reserve banks more representative of the economy, and that's even more true today. The regional reserve banks have shed the influence of bankers. Their directors are broadly representative of their communities, including labor union members, whilst the Board of Governors has often become much more political. And I agree with Peter that the New York Fed is something of an exception. It has often been captured by the bankers in New York, and therefore they were not always acting in the interests of the public. That's not inevitable. There were, as I said, Presidents Strong, who was very definitely correctly named. There was Sproul and Volcker. I worked in the Kennedy Treasury, and Paul Volcker came to be my boss, so I've known him since 1961, and I can assure you no one told Paul Volcker how to run the New York Fed. There are three major issues on which Peter and I disagree pretty fundamentally. First is the issue of independence. Second is safety and soundness of regulation. Third is the role of the U.S. president and what I regard as the increased politicization of the Fed. Can we keep the Fed out of politics? Should we? On this issue, Professor Conti-Brown and I are far apart. I've made this a separate issue, but it is truly part of independence. So let me start with independence. The book says that the reason is to isolate monetary policy from politics. It doesn't go on to say that the main reason for the separation is to avoid the use of monetary policy to finance the government's deficits. That was what they had in mind, to prevent inflation. That's what the argument was about. Who was better able to prevent inflation by an independent Federal Reserve? Was it the Congress or the agents of the Congress in Washington, or was it the bankers representing the public out in the prairies? That was a lesson on which bankers, economists in 1913, most of the public, Congress, and members of the Wilson administration, including the president, agreed. They all accepted the gold standard as a means to that end. The extent of the agreement on price stability was much greater then than now. The early Fed had two strong provisions to prevent inflation, just exactly two. One was a monetary rule. The initial rule was the gold standard. That weakened in the 20s and disappeared in the 1930s. The current Fed responds to noisy current data as if it were God's truth. A rule would give markets and the public better information about future policy actions. The current procedure increases uncertainty greatly. It sets off a raft of discussions about will they, won't they, are they going to, won't they? What the hell does all that have to do with the price of beans? Very little. What people would like to know, or should want to know, is where are we going to be a year or two from now when the policy actions that they take today have their effect? You get no information from the Fed about that. Will they increase the rate in June? Who knows? They don't know. So how can you know? That's a very bad system, one which creates massive uncertainty that we could avoid. The second restriction in the 1913 Act was a total prohibition against direct financing of the Treasury. In World War I, the Fed circumvented this prohibition by lending at below-market interest rates to bankers who bought the Treasury bonds to finance the war. Soon after, the Fed learned to use open market purchases to circumvent the prohibition totally. It couldn't finance the Treasury by lending directly because the law prevented that, but it could buy the Treasury's bonds in the open market as soon as they were issued. The two prohibitions designed to protect the public from inflation or deflation were completely gone by the early 1930s, and no rule replaced the gold standard until the U.S. agreed to the Bretton Woods rules after World War II, and I'll come back to that. We can probably accept that financing the two world wars by inflating was an acceptable violation of the independence. Unfortunately, the violations continued. Treasury Secretary Morgenthau would not tolerate the slightest increase in market interest rates. Peter referred to Eccles as the most aggressive or independent Federal Reserve chairman. The opposite was true. The Fed mostly accepted Morgenthau's demands, and his frequent threats to use the profit from devaluing the dollar that he had gotten when the dollar was devalued, that he would use that to purchase debt in the market and engage in his own open market operations. He didn't like, if it was an eighth of a point increase in interest rates, he thought the earth would shake. He did things like invite all the members of the Open Market Committee to his house to berate them and so on, and to tell them that I think at the time a quarter point interest rate increase would be a disaster for the country. The Fed responded to political pressure and didn't permit wartime interest rates to rise until 1951, 5 years after the end of the war. It felt, if you read its discussions, it just felt it didn't have the political clout to do anything about that. It later acquired that clout, a lot of it with the help of Senator Douglas, a Democratic senator from Illinois, and a distinguished economist. The Martin Fed began in the 1950s with a policy of what was called bills only, and that was very controversial. The left wing of the political spectrum wanted the Fed to engage in all kinds of operations in the long-term government market. Martin, who at the time wanted the bond market to be able to stand on its own 2 feet after all the years of nurturing through the war and the 5 years of post-war, didn't want to engage in any operation that involved purchases of long-term debt. And so he, under the influence of his chief economist, Winfield Riefler, came up with bills only, sometimes bill preferably. But by the 1960s, Martin had a change of heart. He became convinced at the time of the Kennedy administration by a political argument that said that Congress passed the budget and the president signed the budget, and therefore he was obligated to help finance the budget. Now that's the exact opposite of what the Federal Reserve Act was designed to do, to keep him from financing the government budget deficit. But that's what he decided he had to do, and the result was that he began to build the money growth and credit growth. And when he left office, we were already in the beginnings of an inflation, and Arthur Burns became the chairman. Arthur Burns financed deficits with money and blamed labor unions for inflation. That's what you get when you get a political Fed. You get the untruths, call them lies perhaps, that happens. Burns said, well, it's the labor unions that are causing the inflation. So he sprinkled a little more money into the system. As a distinguished scholar and the former head of the National Bureau for Economic Research, he must have known better. And surely if he didn't know better, his very close friend Milton Friedman would not hesitate to tell him. So Burns gave up Federal Reserve independence in peacetime for the benefit of President Nixon. And Peter quoted some of the relationships between Nixon and Burns. Burns did things like attend cabinet meetings, and he was really thought of himself. as part of Nixon's administration. And that continued until Paul Volcker, an independent cuss, if there ever was one, restored the independence, and Greenspan maintained it. But the Bernanke Fed, after preventing a possible disaster, financed the enormous government budget deficits at low to zero interest rates. As an academic economist who knew both Burns and Bernanke, it hurts me to say what I'm going to say, that the two worst Fed chairmen to date have been academic economists, Burns and Bernanke. They didn't lose independence, they gave it away willingly. And Bernanke broke the post-war understanding that major nations would not engage in competitive currency devaluation. That was the essence of one part of the Bretton Woods Agreement. There had been competitive currency devaluations in the 1930s. They had not worked any better than they've been working recently, but it was the agreement that Keynes began and the U.S. Treasury continued to ban further, to get the leading central bankers to ban further efforts at competitive currency devaluation. Bernanke called it QE, but its proper name is currency devaluation, and it has now been copied by Japan and the ECB, even to using QE instead of a more honest appellation. Do you think that central bankers would lie to you? Let me turn to safety and soundness. Professor Conti-Brown likes Dodd-Frank and the regulations pouring out of the Fed. He even approves of the Consumer Finance Protection Bureau that permits an administrative agency to use Federal Reserve revenues, taxpayer money, to enforce regulations on which Congress has no say. Now, our Constitution has two sentences that are hard to misinterpret. One is the sentence that says, Article 1, Congress makes all laws. Another part of the Constitution says, Congress appropriates all monies. Now, you can be a lawyer and you can play with those words, but it's damn difficult to get the sentence that says Congress makes all laws to mean anything but Congress makes all laws. But where do these laws come from in our system? They come from the administrative agencies, not from Congress. And where does this administrative agency, the Consumer Finance Protection Bureau, get its money? It gets it from the Federal Reserve. And what is that money? That's money, 90% of which goes back to the Treasury. So it's taxpayer money. So here we have an agency which makes its own rules and some really whoppers, that I can mention in a minute, and pays for them by simply dipping its hand into the Treasury. Our Constitution forbids such actions. That's what CFRB does. It is an outrageous violation of the rule of law. My reading of the history of financial crises is that regulators locked the door against the source of the last crisis. Neither regulators nor others can foretell how the next one will develop. They completely missed the causes of the Great Depression of 1929, the Great Recession of 2008, and much in between. With that in mind, I testified 4 times on the Dodd-Frank bill. I urged less discretionary regulation with a rule for the largest banks that they be required to hold a minimum of 15% equity reserves. My proposal became the centerpiece of the bipartisan Vitter bill that I helped to write. It never was voted on. The large New York banks prefer regulation and the corrupt arrangements of the current regulatory system. This permits them to negotiate circumvention of the rules that the Fed writes, and it penalizes competitors who are smaller than they. Current costly regulation is one of the main reasons the number of small and medium-sized banks has declined greatly. There are now 5,300 medium and small banks. Sorry, in 2000, there were 8,300. The small banks and the medium-sized banks are down 30%. Now, those banks are important because they lend to local businesses that are starting up, to new companies that are starting up in local regions where they don't have careful balance sheet and income statements. Local banks do a lot of their lending on the basis of, we knew your father and your grandfather, and you come from a good family, and therefore we're willing to lend you money. And you have
Allan, we got to get maybe a couple of minutes so you can
Okay.
get to your last point because we have a big conversation to continue.
So, briefly, the Fed has now increased equity capital, and that makes bank management much more concerned about risks, and that's a good. And their principal stockholders reinforce the attention to risk. The bank's incentive is to look for all kinds of risk, not the specific risks that the regulators guard against. With administrative regulation, what prevents costly, excessive regulation of the kind that we see in the CFRB? Nothing. We just had the MetLife case. A courageous judge looked at the government's case and found it full of opinion and devoid of facts. To support her opinion, Judge Collier called the government's case fatally flawed because of the absence of facts to support the government. Wouldn't it be better to have a rule? I think so. Is anyone in authority concerned that hundreds of medium-sized banks have closed? I believe that the father of the Constitution, James Madison, would be distressed at the constitutional violations of the regulators. For example, in CFRB, and I'll answer that in the question period if one would like. And Thomas Jefferson, George Washington, Alexander Hamilton, and John Adams will join in the protest. This is naked, authoritarian government, more at home in the former Soviet Union than in our country, which purports to observe the rule of law. Finally, Professor Conti-Brown wants the U.S. president to have authority to fire the chairman of the FOMC. He would remove the Reserve Bank president as voting members on policy decisions and in other ways increase the politicization of the Fed in the interests of what he believes would be greater accountability. I don't think he tries to support his case. I believe the way to greater accountability is to require the Fed to adopt and follow a rule of its own choosing. That's the proposal that John Taylor has made and which I have signed on to. Greenspan showed, by following, more or less following the Taylor rule, Greenspan showed that he could get the best period for Fed in its first 100-year history with low inflation, steady growth, short recessions, quick recoveries. That's what we want, that's what we should have, and that would be a great improvement over what we have now. Do we have any idea about how the Fed will eliminate the $2.5 trillion worth of excess reserves on its balance sheet? Will that cause inflation, recession, or both? No one knows because the Fed is moving from day to day. The Fed needs reform. Discretionary judgment has given poor results, alternating periods of inflation and unemployment. Consider this benchmark. Under Bretton Woods, the Swiss franc was worth 20 US cents, and Swiss per capita income was a fraction of US per capita income. Now the Swiss franc is worth more than $1, 5 times what it was worth before. Has more cautious, less inflationary, more rule-like policy of the Swiss National Bank and the Swiss Fiscal Authority hurt Switzerland? Its per capita income is now larger than ours. The lesson, I believe, is discretionary policy is costly and has cost our country. The best reform is a rule-based policy of moderation. That would benefit our economy and be a step toward greater exchange rate stability. The dollar remains the world's principal currency. A monetary rule here would encourage others to make a similar commitment, thereby stabilizing exchange rates and reducing economic uncertainty. Thank you.
Thank you very much, Allan. That's brilliant. So, Alex, we've blown through our time constraints. If you could
I won't blow
speak
through
as
my
quickly as
time
you could.
constraint, Mr. Chairman. In this book we're discussing, Peter has produced a highly informative, wide-ranging, but also very specific and detailed work of history and analysis, covering the remarkable institutional evolution, including intellectual evolution, or the shifting of ideas, for a complex structure known as the Federal Reserve in a very complex environment. Among the other provocative effects of this book on me are that I keep wondering what new ideas and theories the Fed will be trying out on us 10 years from now. Let's address, as Peter did, and Allan also, power. The Fed has obviously come a long way since it was, as Peter describes it, an obscure backwater government agency. That's hard to imagine now. And of course, Peter already told the wonderful story of how the Fed wanted to sit in a more prominent place in the state event. And Wilson said they could come in after the fire department. Well, little did Wilson know that the Fed would one day become the global financial fire department. And it would be the fire department. Of course, the Fed has made and doubtless will continue to make great mistakes. Not all mistakes, but some mistakes. The power of the Fed, combined with its propensity for mistakes, which is natural when you're dealing with uncertainty, makes it, in my opinion, the most dangerous financial institution in the world when it comes to the creation of systemic financial risk. Now, put that together with the idea of independence. Peter rightly, I think, discusses a lot of factors which impinge on the independence of the Fed. But to the extent the Fed has meaningful independence, combined with its power and the riskiness of its judgments and its actions, the bigger an institutional puzzle it represents, and the more necessary is Peter's second book, which he's working on. In the famous conclusion of John Maynard Keynes' general theory, he tells us that it is ideas which are dangerous for good or evil. I think this is especially true of the ideas which come to dominate the minds of central bankers. This is something that we really can't focus too much on. Which ideas are dominating the minds of dominant central bankers, and how are those ideas moving? And of course, the most important minds are those who lead the Fed. And this is why I think Peter's examination of the shifting ideas that have led the minds of the Federal Reserve is absolutely key. He tells us in the beginning to think that the Fed would create fiat money was outrageous. We're fighting words is the word of the book. And Carter Glass said nothing could be more ridiculous than to say the Fed will create fiat currency. Of course, today we're used to the idea that the Fed is the leader of the worldwide fiat currency system. In discussing William McChesney Martin, Peter has this line: the keeper of the currency is the one that has to enforce the commitment not to steal money through inflation. Now we have a Fed formally committed to perpetual inflation. These ideas change around. And as Peter points out, it is not the case that there are objectively correct answers to the problems of monetary policy, and that they are formed with what we can not unfairly call ideology. So Peter observes in his book, central banking practice is plagued by uncertainty, model failure, imperfect data, and even central banker ideology. I just didn't know about the even, Peter. I would just say and central banker ideology. Central bankers are adjudicating between conflicting claims, he writes, and conflicting views of that uncertainty, these failures, these ideologies. Well, this may make us think of a great letter which was written to the Financial Times a year or two ago, which said, in mathematics, there's one right answer. In literature, all answers are right. And in economics, no answer is right. Because the uncertainty is so high, Peter's word adjudicating, well, it's arguable, might be replaced by the word guessing. And I think there's a lot of guessing involved. I mean, guessing by knowledgeable and intelligent people, but guessing nonetheless. Because uncertainty is high, the natural human reaction is to cluster your ideas, to come up with common ideas and reinforce each other's repetition of these ideas. Now, Peter discusses what he calls, and others have called, cognitive capture. But I think a more accurate description is cognitive herding. Cognitive herding is the natural human reaction of all of us to great uncertainty. We want to know what the people we respect are doing and be doing the same things. Well, there's so much in this book. It would be fun to talk about, but the chairman has already reminded me that I have to move right along, so I'll make only two more points. One, briefly, Peter mentioned lots of metaphors, and in a great part of the book, he discusses William McChesney Martin, of course, the longtime Fed chairman, and what Peter calls the poetry of central banking, referring to Martin's love for metaphors, the most famous being the chaperone at the party, and how Martin became the Fed's chief rhetorician. And of course, this was appropriate for a Federal Reserve chairman who studied not econometrics, but when he went to Yale, English literature and Latin classics. And it makes me think we maybe need to change the line of Keynes a little bit to say sooner or late it is metaphors that are dangerous for good or evil. I think there's a lot of truth in that. Last point is Peter's suggestion that aspects of the Fed are arguably unconstitutional. I recommend his discussion of that for your consideration. But to me, it comes down to an even more general point, and Allan touched on this in his remarks, of the Fed and its relationship to the elected branches, to the executive, which would like to get its deficit budget financed, and to the legislative representatives of the people. Peter quotes Bernanke as telling Janet Yellen, "You have to remember that Congress is our boss," but I wonder if the Fed really believes that. Or do they want it to be that Congress is their boss? That's what, as Allan said, the Constitution says. And I would just add that the more it is true that the Fed has independence from the elected branches and the Congress in particular, the more intriguingly alien its structure is to the fundamental constitutional order. And in the opposite case, the less independent it is, the more congenial it is to the fundamental order of checks and balances. Well, every generation wants to reform things and reform the Fed among them. And Peter, thanks for writing such an interesting book to let us think about this. I think you are bound to be testifying at the hearings for the Federal Reserve Reform Act of 2020 something. Thank you.
Thank you very much, Alex. And to be fair, I think that kind of might be in Peter's book the answer to the question I presented you with. That to the extent that we have accomplished an independent Fed, then we've designed something that's perhaps not something that was envisioned by the founders. And so it's almost like an impossibility to wade in there and do anything that would be constitutional. So with that, we could open it up for questions and answers from the floor. And if you could please wait for the microphone so that the TV audience could hear you as well. And please try to make your question in the form of a question rather than a statement, because we want to get as many questions in as we can. I'll start over here.
Thank you very much, first and foremost, for the books and for everything. When we look at today, we talk of the idea of the independence, and we see the money printing that's happening. To your point, we were on a gold standard, quasi-gold standard, then unhinged. We've had a lot of promises about growth, but we've never had growth. As the Federal Reserve's balance sheet increases, the Fed remittances increase to Treasury. So not only do we have more printing, as of today, the Wall Street Journal reported that $19 billion in the reserve capital account was taken by Treasury. So now it's $117 billion of remittances. When we look globally, the Swiss, who the Swiss franc is basically, the dollar lost 80% of its value since we left gold. Now they've left gold, printing money. Will this stop? When we see this historically, once it gets going, it never stops. What are your thoughts on that? Because it just seems that more and more money is being printed, more is going back, and it becomes an essential part of the budget. It's almost half of interest expense right now.
Peter writes about that in the book.
Something that's really interesting to think about is that there's nothing in the Federal Reserve Act that dictates those remittances. And in fact, the Fed's vaunted budgetary autonomy, I wonder what Professor Meltzer makes of this constitutionally speaking, is without parallel anywhere else in the administrative state. Not only is the Fed not subject to appropriations, but it literally creates the money with which it funds itself. Now, I'm untroubled by this, both constitutionally and as a matter of policy. I think that this is a place where the ability to maintain an insulated, a word I prefer to independent, an insulated monetary policy is most effective. If the Fed is subject to the appropriations process each year, then there ends the Fed's ability.
But the original design was that it charged a fee.
So the original design, exactly, and this is, spend a chapter on this, is charging a fee to the member banks for the services that the Fed provides, including clearing of checks and that kind of thing. And it still does this. It still charges those fees, and that accounts for about 25% of the Fed's budget. So one thought would be, okay, just shrink it down so that the Fed should be only a quarter of what it is today. It's an intriguing proposal. But the thing that's important to keep in mind is that very change, the elimination of the gold standard, the elimination of the real bills doctrine, what Professor Meltzer has elsewhere called the Riefler-Burgess doctrine, or a variant of it, and the elimination of reserve bank autonomy has meant that the Fed has grown not by legislation but by tradition into the model that we have today. Its remittances back to the Treasury were a defensive, preemptive move to keep that budgetary autonomy. There's nothing in law that says that it must continue. So in terms of what can happen in the future, that's why these kinds of things matter so much, elections, personnel, and the like, because these traditions can change that course.
So they'd be just as justified if they gave the money to me?
There's nothing in the Federal Reserve Act that says Kevin Hassett can't return. I think a lot of people would sue if that ever happened.
So we'll do a little ping pong. I promise this fellow the next question, and then we'll look again.
Hello, this should be a pretty easy one for you. Earlier, you mentioned that Donald Trump might have a problem with certain policies, I suppose, that Janet Yellen has enforced or, I assume, created. So can you talk a little bit more about the contradiction between whether Donald Trump or Donald Trump presidency would accept Ms. Yellen or would have a problem and dismiss her?
So Donald Trump is an enigma to me. If you have better insight into him from a policy perspective, I'd love to hear it. I've read a lot, and I'm not closer to understanding exactly what his monetary politics are. He praises Yellen and the Yellen Fed, not in so many words, but for low-interest environment. The thing that I fear about a Trump administration, why it looks so different from anything else we've seen in history, is that Donald Trump has identified himself as someone who is linking short-term economic results with his own political successes. That's the barometer he's looking at. He seeks to consolidate power. He's the boss. And so the idea that a central bank would pursue a policy that is antithetical to short-term economic interests would seem to be anathema to a Trump administration. And it's not clear to me that from his public statements about even fiscal management that he sees the Fed as anything other than a kind of piggy bank. Just an hour before we came on, I was reading a headline that said, there's no such thing as a U.S. default because we can just print our way out of that problem. That's called hyperinflation. And so that's what makes me so uncomfortable about a Trump administration. That looks to me like someone who would shoot the chaperone who tried to pull a punch bowl away before allowing that to occur.
Both Allan and Alex want to jump in.
Yeah, great.
Allan got his hand up first, Alex.
I have a very short comment. I don't think anybody knows what a Trump administration is going to be like. I thought that Donald Trump figured out a very clever, unique way to win the primaries. That is, without spending much money. You said something extreme every day, and all the journalists rushed to interview you. So you had more TV time than anybody else could afford to buy. And that was a great winning strategy. And now one hopes that now that he is going to be the nominee, we'll see what he actually is going to say about what he's going to do. But I don't think you can make any judgment on the basis of what he did, because those were all statements designed to get himself on TV and be interviewed.
Allan, but I mean, who better than you, the leading historian ever for the Fed? So is it ever the case that some president said, darn it, I want to fire the Fed chairman, and then someone said, no, you can't because of this legal technicality or something like that? Did that conversation ever happen?
Apparently, Kennedy wanted to fire McChesney Martin, but didn't have wasn't willing to carry through on it. I'm sure that I'm pretty sure that Nixon offered Martin, who had one more year as chairman. He offered him a job in the Treasury or something in order to get Burns into the Fed, and Martin told him no. So it's not without precedent.
Well, LBJ actually commissioned a formal legal opinion from his attorney general to determine whether he could fire William McChesney Martin after Martin had raised the discount rate contra Johnson's wishes. And it was exactly the ambiguity identified that made him say, you know what, not worth it.
Oh, so
Peter, when
but
you
they didn't tell him you can't. They said
Well,
that
said,
if you do, it'll be litigated.
Exactly, right.
Peter, when you described the Trump theory of the fiscal role of the Fed, I thought you were describing Lyndon Johnson. On forcing out the Fed, Truman pretty well forced out the chairman of the Fed because he wanted to replace him with William McChesney Martin, who he thought was his man. And
Who disappointed him.
Who disappointed him, and Truman thought he was a traitor. But that's more to the point, I think.
Right, but at that point, the term was almost up.
Okay, we've got time for a few more questions. We've got somebody in the back. I've got somebody over here, and then I've got a lady in front and a person in the back. That will so 1, 2, 3, and then 4. You'll get the last question in the back left, back there. You get the last question. You're the fourth.
Peter, congratulations on a great book.
Good to see you,
You've done a real service to us. But no one's mentioned the figure I think is at least a pretty good analogy to Trump. I think it's Andrew Jackson. And Andrew Jackson and the war on the Second Bank of the United States, the war on Nicholas Biddle. I think Trump, who is, I think, presented himself as the anti-elite candidate. I mean, the candidate of the hinterlands, of the great forgotten people out in the wilderness. And certainly Jackson played that role very adeptly and took on, elite financial power centered in the Second Bank of the United States, which was our central bank. Do you see a potential battle similar to that?
So I see echoes of Jackson and Thomas Jefferson too, and frankly Abraham Lincoln. I'm choking as I say this in Donald Trump, in the sense that he's seeking to say, I'm a frontiersman, a man of the people. There's nothing about his biography that authenticates that claim, unlike well, not so much Thomas Jefferson, but Andrew Jackson and Abraham Lincoln. The difference, though, and the reason I don't think that we can see in Trump a thoroughbred populist, is there's no governing principle that motivates. Before a week ago, I literally had no idea at all what his views were on something as important as the central bank, and I couldn't say the same thing about any of the other Republican candidates. And that's the thing that I think is so interesting. It's not about populism against the interests with Donald Trump, because there's so many different, frequently contradictory veins within what Trump has articulated.
Okay, so we've got question number 2, I think, was over here, if I'm remembering my numbering scheme correctly. And we are running a little late, so if you could make the question brief, I'd appreciate it.
Very simple question. What role should financial stability play in setting monetary policy?
I've been hogging the good questions.
Yeah, Allan's.
You're the author, Peter.
I believe the Fed should not be in the financial stability business. I believe that we have the FDIC and the controller, but especially the FDIC, and I think that should be sufficient. So we should strengthen the FDIC and take the Fed out. And the reason for that is because it creates conflicts for them. Multi-purpose agencies generally don't do a good job. The best job gets done if you concentrate their mind on the task that they're supposed to carry out. And for the Fed, that's clearly monetary policy.
Quick point from Alex.
The original purpose of the Fed in creating a so-called elastic currency was financial stability. And in fact, at the time of the foundation of the Fed, there were forecasts that there would no longer be any financial crises or cycles once we had the Fed. Obviously, a very poor forecast.
But the best forecast we've ever had, it turns out that they're all so bad. But on the point of regulation, when I wrote about your book in the Wall Street Journal, I mentioned that it seemed to me, reading your history, that economists who think about independence are thinking about using monetary policy to get the economy humming in an election year, and they don't want that to happen. And that it looks to me like Federal Reserve chairmen have kind of traded regulation. And that they, Greenspan had this exchange with Gramlich that you write about, where Gramlich was saying, hey, this housing lending is getting out of control. But we had a Congress that wanted a lot more housing lending, and it kind of looks like the Fed didn't want to step up and regulate to stop it, because they thought if they do that, they might lose the independence they care about. Sure. And so I concluded, but I haven't talked to you about this, I concluded that your book says that we ought to separate regulation from monetary policy completely, because, because the regulation was so political. Do you agree with that?
Well, I don't go quite that far. I would love to see that institutional question come to a livelier debate. There's simply no question that governance gets muddled the more functions we add to a single institution, which is why I'm surprised a little to hear Professor Meltzer is not in favor of separating out consumer financial protection, although I seem to hear you say that you just eliminate those.
He would eliminate it, yeah. So,
which I'm not in favor of.
Okay, so we have question number 3 right here.
Thank you. My name is Li Yang. Thanks for your presentation. But just try to think about Fed. The purpose is just for improving economy, inflation, or employment, whatever reason they say. But why don't they regulate? When you want to have economic good, you got to regulate financial institution. They are just run out of just all kinds of trouble. And there's no real doing some service for community, and then their interest rate federal charge to the financial institution is so much gap between the charge to the consumer or the student loan. It doesn't make sense. It's a distortion of fair market mechanism. So, and then it's also against our common sense. The financial institution, their assets coming from the consumers or account holders. Sure. But they are earning or revenue, they didn't really distribute to the consumers. Actually, they are penalized consumers.
Could you come to your question, please?
My question is, can we really ask the Fed to really do their responsibility to do something to promote economy and reduce inflation rather than doing the opposite direction?
Yeah, this highlights a place where Allan and I agree very strongly, and a place where we disagree. I don't think rulemaking is unconstitutional, and so I think that it is appropriate for the Fed to have regulatory authority over the missions that the Congress has laid at its feet. And that's a place where we disagree. A place where we agree is that to the extent that we can keep those regulations as dumb and stupid and simple as possible. And here, from the financial stability perspective, the example here is jacking up the required levels of equity for very large banks is a clean, simple mechanism that has bipartisan enthusiasm. Missing from that coalition, however, is the banks themselves. And so that's a place where I think it's appropriate.
Okay, so let's move for the last question to the back, in the back corner there.
Thank you very much. Very interesting discussion. My question is just about finance in general, and it's my understanding that since the charter of the Federal Reserve, that finance has changed and grown dramatically in terms of technology and the size, and even probably in the last 30 years. I was just wondering if you could discuss that, just obviously briefly, but have we reached some sort of peak of finance? Has it been exponential for the last little while and it's going to slow down? So maybe the role of the Fed will also slow down and the changes there. So just about the interaction between the growth of finance and the Fed. Thank you.
The financial theory on this, which is a very mathematical literature, is pretty clear on this, in that to have an efficient finance system, you need to have the same number of assets as you have possible future states of the world. And so therefore, the financial markets are always going to be innovating new, I mean, in our lifetimes at least, they're going to be innovating new products because we have very incomplete financial markets. Sorry to stick the math point in at the end, but thank you all very much for coming and for watching on television if you've been doing that. I think that when we look back on this day, it'll be a very interesting and kind of historic moment where a great historian of the Fed who will be known, I think, forever and ever, maybe doesn't hand the torch, but maybe sits for the first of many times on the stage with the next great Fed historian. Thank you very much for coming.
Thank you.